Welcome back to the channel. We are diving deep into a market landscape bristling with change, from the shifting tides in global central banking to the vibrant, yet often underreported, surges in emerging economies. Today, we confront a fascinating dichotomy, the cautious optimism permeating Wall Street alongside the robust, undeniable growth trajectory of the Indian market. We'll unpack the critical developments, from the Federal Reserve's new leadership to explosive corporate movements and the ever-volatile commodity markets, ensuring you are equipped with the insights to navigate the days ahead. Our primary focus today will be on India's economic engine, its resilience, and what it means for your portfolio, before shifting gaze to the dramatic shifts in global finance. Let's begin our journey in one of the world's fastest-growing major economies, India. While our immediate news backlog might not feature specific breaking corporate news from the subcontinent, the macroeconomic picture continues to paint a compelling story of resilience and long-term potential. The Nifty 50 and Sensex have demonstrated remarkable fortitude, frequently hitting new highs or consolidating strongly even amidst global volatility. This upward momentum is largely fueled by robust domestic consumption, significant government infrastructure spending, and a burgeoning manufacturing sector that is increasingly integrating into global supply chains. The Indian market's ability to absorb global shocks speaks volumes about its inherent strengths, driven by a young demographic and a rapidly expanding middle class eager for growth. Crucial to India's stability has been the Reserve Bank of India's proactive and prudent monetary policy. The RBI has skillfully balanced inflation management with growth imperatives, fostering an environment of relative stability for the Indian rupee, which, while subject to global currency fluctuations, has largely remained stable compared to some emerging market peers. Furthermore, we've observed a fascinating shift in capital flows. While foreign institutional investors, or FIIs, have shown occasional periods of caution, domestic institutional investors, or DIIs, continue to provide a powerful counterweight, channeling local savings into the equity markets. This growing reliance on domestic capital provides a crucial cushion against external shocks and underscores the maturing nature of India's financial ecosystem. Diving deeper into specific sectors within India, the banking and financial services sector continues to be a cornerstone, benefiting from credit growth and improving asset quality. The technology and IT services sector, despite global headwinds, remains a significant earner, adapting to new technologies and services demands. Renewable energy and infrastructure, driven by ambitious government targets and private investment, are experiencing explosive growth, creating vast opportunities. Even traditional sectors like manufacturing and consumer discretionary are undergoing significant transformation, bolstered by digital adoption and increasing disposable incomes. These broad-based growth drivers suggest a diversified and resilient economic structure, making India a compelling story for long-term investors looking beyond the daily headlines. In essence, India presents a powerful long-term investment thesis rooted in its demographic dividend, structural reforms, and a government focused on ease of doing business and attracting foreign investment. The nation is on a path to becoming a global economic powerhouse, and while no market is without its risks, the foundational elements for sustained growth appear firmly in place. Investors tracking the Nifty and Sensex are witnessing not just market indices, but the manifestation of a nation's ambition and potential. Keep a close eye on India. It's not just an emerging market, it's a dominant force in the making, shaping the future of global finance. Now, let's pivot to the crucial landscape of global monetary policy, specifically the Federal Reserve. A seismic shift has occurred with Kevin Warsh taking the helm as the new chairman. Recent Fed meeting live updates highlighted Varsh squaring off against a notably hawkish committee, setting the stage for potentially more contentious policy debates. Kalshi traders, known for their predictions on political and economic events, anticipated a more united Fed board at Varsh's first meeting, suggesting that despite initial hawkish pressures, some consensus might be forged. This transition is not merely a change of personnel, it marks a potential inflection point for global interest rate policy and market sentiment, impacting everything from borrowing costs to investment decisions worldwide. The appointment of Chairman Varsh is already sending ripples through financial markets. Fidelity bond managers have warned that Varsh may spur market volatility, citing his known policy leanings and the uncertainty associated with a new leader. Adding to the political dimension, Senator Warren controversially stated that Trump has put Fed's Varsh in terrible box, hinting at potential political pressures influencing independent central bank decisions. However, not everyone is bearish on fixed income. Goncalves, a prominent market strategist, suggests that we are entering a summer of the bond market, implying that despite potential volatility, opportunities could emerge as investors seek stable returns. This contradictory outlook highlights the current uncertainty in the fixed income space, making careful duration management paramount. Beyond the Fed, global market conditions are also under scrutiny. Australia's financial regulators are actively probing private credit lenders and warning on valuations. This signals a growing concern about potential overheating and risk in the less transparent private credit space, an area that has seen significant growth in recent years. Meanwhile, the broader S&P market faces its own vulnerabilities. Reports suggest that hedges removed due to Iran deal leave S&P vulnerable on Fed Day, implying that geopolitical developments, alongside central bank actions, are creating a more precarious environment for equity markets. Investors are navigating a complex web of interest rate uncertainty, geopolitical risks, and valuation concerns across various asset classes. Shifting gears to corporate news, few companies capture the imagination and generate as much speculation as Elon Musk's SpaceX. The question of got SpaceX stock. Here's what to do next looms large for many private holders, as an IPO remains hotly anticipated. The hype is so intense that crypto traders are wagering on SpaceX's IPO market cap, with some eyeing payouts that could top 100x on derivatives markets, highlighting extreme bullishness. Yet, famed investor Michael Burry, known for his big short bet, says he's tempted to bet against SpaceX, but passes on expensive options, signaling caution about its lofty valuation. The paradox is that even passive investors, who once shunned volatile assets like Bitcoin, are now finding themselves forced to own SpaceX, particularly through broader tech funds, despite it being 3 times more volatile than Bitcoin. This situation underscores the immense, yet speculative, enthusiasm surrounding private space ventures. Beyond the SpaceX speculation, concrete earnings and regulatory news continue to drive significant individual stock movements. Comfort Systems USA, ticker FIX, saw its shares lifted by strong results in its first quarter, demonstrating robust demand in the commercial and industrial HVAC sector. Conversely, medical device giant Boston Scientific, ticker BSX, faced investor disappointment as a below-expected outlook pressured its stock in Q1, raising concerns about future growth projections. In the biotechnology space, UniQure shares soared after an FDA reversal on its Huntington's therapy, injecting new hope and significant value into the company following positive regulatory news. However, not all tech names fared well. Mobile advertising platform AppLovin, ticker App, slid amid competitive threat and AI disruption risks, highlighting the intense pressures and rapid changes within the adtech landscape. These examples underscore how specific company performance, regulatory decisions, and competitive environments remain pivotal for stock trajectories, even in a macro-driven market. Turning to commodities, the oil market has been a hotbed of activity. Despite recent volatility, Rapidan Energy Group's McNally views the oil sell-off seen as unwarranted, suggesting that underlying demand fundamentals and supply constraints may support prices in the medium term. This perspective challenges the narrative of a prolonged downturn and hints at potential upside. In a fascinating development linked to oil prices, Egypt's pound becomes world's top currency as oil shock reverses. The reversal of a previous oil shock, which often weighs on oil-importing economies, has evidently bolstered Egypt's economic outlook and strengthened its currency, demonstrating the profound and often counterintuitive global impact of energy market dynamics on national economies. Finally, for investors seeking diversification, the debate over global ETFs, which is better, SPGM or VWO, remains pertinent. While SPGM offers broader global exposure, VWO provides a deeper dive into emerging markets, including significant allocations to countries like India. Your choice depends on your risk appetite and specific regional exposure goals. As we wrap up, the market narrative is clear. India presents a compelling long-term growth story. The Federal Reserve is entering a new, potentially volatile era, and corporate performance remains a key differentiator. Stay agile, stay informed, and always conduct your own due diligence. Thank you for tuning in, and we'll see you next time with more crucial market insights.